The impact of rising interest rates on Australian housing. Let's have a look. Hello everyone, Florian.heise here and welcome to another episode of HeiseSays. Grab your stein of coffee. Let's look at this article from news.com.au written by Tarek Brooker. How interest rates increase would impact the Aussie house prices. And many people are concerned, or they're worried, or some are actually hoping that we will see an interest rate increase. That right now we're sitting at 0.1%. Okay, and I'll just bring up the ASX rate predictor, and we can see what the predictions are for interest rate increase or a rise. And right now, on the 5th of March, or a few days ago, there's a 75% prediction that it will decrease to 0%. So it's gone down from 81%. You know, what difference would going to 0% make now? Psychologically, I think it would have more of a negative impact on the economy than anything. So I don't see how the Reserve Bank are going to do it. But it's got more to do with the bond trading. So, the RBA has said they're not worried about rising house prices. We can see here from this some quotes on FX Street by Jonathan Kearns. House price gains are not a concern right now, but could be a worry going forward. Reserve Bank head of financial stability Jonathan Kearns said while speaking as part of a Moody's panel. Watching borrowers' ability to pay debt. And to pay some households and firms are struggling to pay debt. They've got buffers in place. Important, there's no deterioration in lending quality, but they're not really worried about rising house prices. They've said they're going to keep interest rates on hold for a few years. So what are they going to do? If bond prices keep going up, they want to control the yield of the bonds because that'll have an influence on interest rates, but people are just selling bonds more and more, so the yields are going up, so they'll be buying bonds. And where does the Reserve Bank get their money from? Well, it's magic money. So let's have a look at Tarek's take on this. So since the overnight cash rate hit 17.5% in January 1990, Australians have seen the RBA cut interest rates 51 times. Now, do you remember that guy? I mean, it's not even on this chart. Yeah. I'm sure there's some viewers in the comments that lived through that had to pay those crazy interest rates. But you would also be earning crazy interest on just having your money sit there. Just imagine your money sitting there and you're making like 10%. Doing nothing. Insane. Imagine how easy it'd be to save for a deposit. So, now after more than 3 decades of interest rate cuts, the cash rate sits at just 0.1%. This has led some analysts to call the bottom, predicting that the cash rate will never be cut lower than it is today. Well, some are arguing that. Even our Reserve Bank governor says that going to negative it actually has a negative effect. It has the inverse of what you think. Negative interest rates, more people will save more because they're losing money. And remember, they just want to get you to consume. They want you to be a good little consumer. Get out there spending. But then again, they'll say, remember, 3% was emergency rates. Maybe we can go hard negative. Maybe we'll get central bank digital currencies. So they'll have such fine control over how and where we spend. It'll be a different world. Then they'll just have to link that to your social media posts. It'll be fantastic. If you're a good little compliant citizen, you get to get more value for money. Can you imagine that? Maybe they'll even get you Karen points. So if you dob in enough people for a wrong think, your purchasing power will go even more effective. I'm being facetious here, but it's almost like something out of science fiction, isn't it? With the economy's recovery from the pandemic still fragile and heavily reliant on government support and household savings, RBA Governor Philip Lowe has stated interest rates would stay low for as long as needed. In a recent appearance before the Parliamentary Committee, Mr. Lowe said that rates would stay at this level for up to 3 years. What do you reckon? I mean, yeah, there you go. Look at this. I updated my chart here on my software to bring in the new, the decrease in rates there, and it was barely 1 pixel move. This was no doubt music to the ears of Australia's 2.1 million property investors and more than 100,000 first-home buyers who purchased property since the pandemic began. With many mortgage holders still facing an uncertain future, the predicted certainty about the stability of interest rates also provided a much-needed boost to household confidence, particularly as a result. The Westpac Consumer Sentiment Index recently hit a decade high. I mean, this is just it. Spend, 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 guys. While the RBA does have a good deal of power to influence interest rates through a number of different tools it possesses, the direction of interest rates are not entirely within their control. They are ultimately guided by the tides of the global bond market. Despite Governor Lowe's view that rates would stay low for at least 3 years, financial markets are seeing things quite differently. According to a report from Bloomberg, credit markets are pricing a 30% chance of the RBA being forced to hike rates by the middle of next year. As the global government bond yields, borrowing costs, continue to rise, the RBA aren't the only central bank beginning to see upward pressure on mortgage rates. In the United States, banks have already started to raise mortgage rates without a move by the Federal Reserve. In the past 4 weeks, the interest rate on a 30-year fixed-rate mortgage has risen by 0.45%. This has resulted in demand for mortgages beginning to cool. According to the U.S. Mortgage Brokers Association, mortgage applications to purchase a home fell 11.4% in the last week's data, with applications for refinancing down 11%. While the level of mortgage applications remains elevated above pre-pandemic levels, if rates continue to rise, demand for property will likely moderate in time. As global bond yields continue to rise, US banks are increasingly finding their lending margins squeezed, forcing them to raise mortgage rates in order to maintain profits and the stability of their businesses. We can see here the spread between 30-year US Treasury bonds and 30-year mortgage rates. Back in Australia, there is an unprecedented consensus surrounding the direction of the property market. Well, yeah, everyone thinks it's going crazy. I mean, I will bring up a tweet here that was shared to me by a viewer of the channel. Hang on, I've just got to find it. I'm so well organized, guys. So well organized. Because it's just crazy. This is just crazy. And I mean, here we go. This was shared to me by Dave Jones. So here's a property. Sold at auction in Sydney. 26 days on the market, so really short time on the market. 225 buyers, 25 registered bidders, 54 bids, and it sold for a premium of $1.7 million. Now he's saying 12 months ago it would have gone for 1.2. And let's just have a look at this place. Let's just have a look at this property. Now, so McGrath have done it, so they probably would have styled it and they would have worked it up. So, I mean, nothing. It's a nice house. It's a brick veneer house. Nothing wrong with it. We look at the interiors. I mean, there you go. The kitchen is a little old and dated, but it's still workable. It's fine. I've just seen, I mean, you can tell they've styled it because look how little stuff is lying around. I've seen others, another viewer sent me some pictures of a property in Southport, like an apartment going for $500,000. And there they hadn't even made the bed. They hadn't done anything. And they were, prices were still going up. It's got a pool. It's on a corner block though. So here we can see, I mean, it's on a corner block. So you've got no backyard. You've got a clothes drying area around the front. You've got a pool and kind of a bit of front yard to play in maybe for kids. 4-bedroom with a master bed. Oh wait, yep, 1, 2, 3, 4. You got a walk-in robe, a little ensuite with a corner shower. What do you have? A little bath. I mean, a wet bar for a rumpus room. So you got a living area there. You've got living and dining here. And this kind of, family room space you'd have here. $1.7 million, everyone. I mean, sure, you're paying for the land, you're paying for the location. But still, $500,000 up in a year. It's going crazy, everyone. The market is just going nuts, particularly for housing. But not for apartments. Not for investment-grade rental stock either. So, across a wide range of analysts and market commentators, there are a few that disagree that residential property is an asset class that is set to boom and likely very strong price growth in 2021. Unlike other housing price booms that have occurred in the recent past, this one is predicted to be the first truly nationwide property boom in years, with very few notable exceptions. But as mortgage rates in the United States and elsewhere continue to rise, the global bond market could slam on the brakes of this would-be multi-year housing price boom. In as little as 15 months' time, Aussie mortgage holders could be staring down the possibility of not only an interest rate hike, but the chance that rates may only rise from here. After relying on interest rate cuts for over 30 years to make paying off our home significantly easier and or faster, the Aussie mortgage holder's greatest friend, the interest rate cut, may be put to rest for the foreseeable future. Well, see, this is the thing. Are they going to go negative? What would that do if we're the first country to go negative? Remember, we're not Australia. We're not that important. We're just like a little cork floating in the ocean, affected by other nations. Everyone. If we do see continued upward pressure on borrowing costs, the RBA is not likely to sit idly by. It will use its various tools to attempt to continue to artificially suppress interest rates. Well, yeah, that's what we're seeing here. We're seeing the Reserve Bank is a completely, well, it's an artificial intervention in the market, like anything. We don't really have a free market. Any places in the world really do. As it stands, the RBA is engaged in yield curve control. In plain English, it has set a target. It does not wish 3-year government borrowing costs to significantly exceed 0.1% and is buying bonds in an attempt to keep borrowing costs in its target range. So far, it has been relatively successful in suppressing rates to its desired level, despite seeing some brief moments where their target was significantly exceeded. However, the Australian government's long-term borrowing costs have seen far more explosive growth in their relative costs. In the past 6 weeks, the cost of the federal government borrowing money for a 10-year fixed term has effectively increased by 79%, with interest rates rising from 0.94% to 1.68%. Despite the Reserve Bank, the RBA's governor's promise of rates staying low for at least 3 years, the direction of interest rates are not entirely within his control. They are ultimately at the mercy of the unpredictable tides of the global bond market. As the global bond market attempts to price in what lays ahead and borrowing costs continue to rise, Aussie mortgage holders may increasingly find themselves caught in the crossfire. Going forward, rates may stagnate at roughly this level or even go slightly lower, again if the global recovery shows signs of faltering. But as the global consensus turns more inflationary future, it's possible the days of bargain basement interest rates may be slowly drawing to a close. So what do you think would happen if interest rates shot up? Think how many people have borrowed to the hilt. Think about our example here. You know how many people are borrowing huge amounts of money to get into housing, and then interest rates went up 1%, 2%, 3%. What if we had 5 or 6%? What if we actually had 3% rates even now, guys, from the cash rate? What would that translate to us in reality? 6% plus. How many people would struggle to pay? How many people would enter mortgage stress? What interventions would the government do? And I'm talking about the government here. What crazy programs would we have, direct mortgage payments from the state? Because, no one wants to see a housing market correction here in Australia. We can't possibly have that. Let me know your thoughts and opinions in the comments down below. And please send me examples of just crazy property, guys, that you've seen around the place that's going for insane amounts. Anyway, guys, thanks for watching. Please like, share, subscribe to the channel. If you're a fan and enjoy the content I create, there are a few ways you can support us. You can join us on YouTube or Patreon. You can support us using our affiliate links from Amazon, eBay, Independent Reserve, or AussieBroadband. You can buy merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, and I'll see you next time. Bye for now.